In the right situation, doing a Roth conversion can save you tens of thousands of dollars in taxes, but it's not always the right solution. And in the wrong situations, it can actually cost you thousands of dollars. I don't want to see you make that mistake. So in today's video, I'm going to share with you 8 common times that a Roth conversion likely does not make sense. Let's jump in. The first one is if you're applying for financial aid or an Affordable Care Act healthcare subsidy. In those situations, the Roth conversion's additional taxable income that it's going to trigger could cost you to lose financial aid money, and or it could cost you to lose part of your Affordable Care Act subsidy. And in some cases, these subsidies can be worth $20,000, $25,000, $30,000 to a family. So you want to be really careful there. The next one is doing a Roth conversion can sometimes trigger your Social Security to become taxable. If currently your Social Security payments are not taxable, you want to look and see, okay, if I do this Roth conversion, is it going to make my Social Security taxable, and what's the impact of that going to be? Another one is if you think in the future your tax rate's going to be dramatically lower or even somewhat lower, why would you do a conversion today at a higher tax rate if you think in the future your tax rate's going to be lower, right? So oftentimes what happens is the required minimum distributions, if you're not paying them now, the required minimum distributions are going to kick in at 73. And oftentimes by your mid-70s, people are starting to enter the slow go or maybe even the no-go phase of their retirement. So they don't need to take as much money out of their accounts. And because of that, their tax rate might be lower. We're going to talk about U.S. tax brackets here in a bit, but in general, if you think your future tax rate's going to be lower, then you're probably better off not doing the conversion. I should say none of this is tax advice. It's not financial advice. I just want to put these things on your radar screen and to encourage you to talk to an accountant, to talk to a fiduciary financial advisor to help you see, is this the right time? Am I thinking about this right? Am I thinking about the right things? Should I do the Roth conversion? Okay, another time it does not make sense, in my opinion, to do a Roth conversion is if you're fairly young. If you're in your 20s, 30s, or maybe even in your early 40s, you still have enough time that you can have what I call the 3 buckets of capital that you're going to be pulling out of in retirement. So part of the challenge is if all of your money is in a regular IRA or a regular 401k, then all of your living expenses that are getting pulled out of these accounts are going to trigger taxable income. But if you're in your 20s or 30s, you have plenty of time to set up the 3 bucket strategy that I talk about in my videos, which is having a tax me later account, which is the regular IRA, the regular 401k, where I'm going to be taxed on it later. The tax me never account, which is the Roth IRA. Once the money's in, you're never going to be taxed on it. And then the tax me as I go account, which is your regular bank account, your regular taxable custodial account, where maybe you own stocks and bonds and you're paying taxes as you go every year as you're triggering taxes. So if you're in your 20s and 30s, you still have time to, based on where you put future contributions into a regular 401k or a Roth 401k, you can get those 3 buckets set up properly without having to do a Roth conversion. So it's much simpler to just do it right from the beginning. And if you're in your 20s and 30s, maybe your early 40s, you still have time to end up with the right amounts in these 3 buckets without doing a Roth conversion. Okay, so that one was if you're too young. The next one is if you're too old. If you're too old, you probably don't have time to let the magic of a Roth account, a Roth IRA work, which is this growing tax-free. If you're 80 years old, does it really make sense to do a Roth conversion? Maybe, but maybe not. It depends on your health. If you're going to live to be 120, you'll probably be glad you did the Roth conversion. But most of us at 80 aren't looking at living to be 120. So we don't have the time is no longer on our side, unfortunately, to let these accounts grow. Another time it doesn't make sense, and people often overlook this, if you're charitably inclined, if you like to give donations to a local charity, the IRS, you can see here in this letter or this note from the IRS, it is 2023-215, which is just a reminder to all U.S. taxpayers that, hey, you can do a qualified charitable distribution if you're over 70 and a half. And if you're doing RMDs, if you owe RMDs, up to $100,000 of a charitable donation from your regular IRA, it will not trigger taxable income. You can take that money out and you can give tax-free gifts to the charity. So if you're charitably inclined, rather than do a $100,000 Roth conversion and pay tax on it and then maybe donate later to a charity, why not just do this qualified charitable distribution? Again, you can look this up yourself. It's the IRS memo 2023-215. And you can see it here, the beginning parts of it in the image here. Okay, so that's another reason. Reason number 7 is if you have smaller accounts. And now this is when we're going to look at the tax tables. Required minimum distributions are only a problem, in my opinion, if they push you into high tax brackets. The U.S. has 7 tax brackets. Let's take a look at that. Now it's the 10% tax bracket and the 12%. Now for most people, if they can take money out of their regular IRA, their regular 401k, and pay 10% federal or 12% federal, for most people that's going to be okay. Now you can see there's a big jump. There is no 13% tax bracket or 14%. It goes from 12% to 22%. So now let's talk a little bit more about required minimum distributions and what they mean and why, if you have a smaller account balance, it might not be as big of an issue. So this is from the IRS. This is the required minimum distribution period. So let's take somebody that's 76 years old. So that 23.7, that's known as a life expectancy factor. So let's take that 23.7. Let's go to this example that Fidelity put together. And here you can see the account balance as of December 31st of the previous calendar year. You look at that, and then you divide by that life expectancy. So if you have a small account balance, $100,000, in a regular IRA, you can see it's $100,000 divided by that 23.7. So it's only $4,200, which is well within those brackets, those lower tax brackets. So even if you had $400,000, we multiply this number by 4, that's $17,000 roughly. So, which likely is going to still keep you in that 10% or the 12% bracket. Now, let's go back to this required minimum distribution periods, and let's look at this life expectancy factor. And you can see as we get older, that number starts increasing. So by 80, it's 20.2%. So essentially, when you're 80 years old, you're going to have to take out about 5% your regular IRA balances. So if you have $2 million, that's $100,000. So that's going to have a big impact. But if you have $200,000 in there, that's going to be $10,000. So it's less of an impact. So it depends on the size. And then another factor, so that was reason number 7. Reason number 8 is if you don't expect to live much past 80, then you can see at 80 is when things start ramping up. You basically take the inverse of this number. So 1 over 20 is 5. And then you can see, what do we get? At 90, it's about 12 years is your life expectancy. So there, you're going to have to take out a little more than 8%. So as we get older, these required minimum distributions become a bigger factor. So what does all this mean? What it means is doing a Roth conversion doesn't always just automatically make sense. There's a lot of financial influencers that are talking about the magic of doing a Roth conversion, the power of doing a Roth conversion. But as they said in Spider-Man, with great power comes great responsibility. And I want you to exercise that responsibility. I want you to look at this and go in being fully informed. So these are things coming onto your radar screen that I want you to know about. And for most of us, because of the dollar amounts, right, when we look at how we take money out of our various accounts in retirement, it can make tens of thousands of dollars difference in various strategies in our lifetime tax that we're paying. And for some people, it can make hundreds of thousands of dollars difference. So there's very few people that would not benefit from talking to an accountant, from talking to a financial advisor, and coming up with a well thought out strategy for where are you going to pull money from when you're retired to meet your living expenses. So I encourage you to think about doing that. At a minimum, you have some things to think about here. I also think you might enjoy, if you enjoyed today's video, you might also enjoy seeing how much income other retirees have. What is their income per year in retirement? And that's what this video here is. The average American retiree's income in retirement. Thanks for watching this video, and I'll see you in that one. Bye-bye.